What if I told you that there is an important lesson that every physician could learn from NASCAR? Keep listening as we dive in. Welcome to the Money Meets Medicine podcast, where we talk all about the personal finance topics you wish you'd learn in medical school. I'm your host, Dr. Jimmy Turner, and here's your co-host, who has recently become enamored with whodunit audiobooks, Justin Harvey.
Thanks, Dr. Turner. I do like a good audiobook. I was on a political biography kick for a while. I got halfway through The Power Broker, which is Robert Caro talking about Robert Moses. And it started out because I was really interested. And then I was like, I got to finish this because I wanted to be the kind of guy that read The Power Broker so that I could, impress all of my friends. And then that was not enough to carry me through. So I hit the eject button and I've been consuming more light and fluffy murder mysteries. Most recently, Cormoran Strike, he's the protagonist. Okay. And this is written by J.K. Rowling under a pseudonym, which was kind of fun. And my wife got me into these. And I also like the Bosch series. The author's name is escaping me. Also wrote The Lincoln Lawyer. But the crime, murder, drama is, you can just pop the earbuds in, and while you're getting a workout in, you can be entertained. It's been a lot of fun lately.
Yeah, my guilty pleasure at the beach, because I love reading. I read every day. But when I go to the beach in particular, is always to pick up a Harlan Coben novel. The books are so good. He's married to a physician, so there's medical stuff in them, but it's always the same theme where there's the story that happens and then there's this family involved in some way. And at the end of the book, those two stories collide in a way that you just can't put together. And then you read it and you're like, oh my gosh, and it blows your mind. And so you know how it works in terms of the structure, but it makes it great because you're like, I can't wait till I get to that part.
Yes, that's fun.
But yeah, so you mentioned Bosch. In this episode, we're going to talk about a guy named Busch, Kyle Busch in particular, and some recent news that's been making waves that is, I just think, fascinating. But before we dive into that, don't forget, we're offering some free resources on Money Meets Medicine. Starting a few weeks ago, the blog posts are coming out and the YouTube videos there. And this content is all in the weekly update, including links to Instagram, Twitter, X. So if you want access to that, including any deals and discounts that we provide the Money Meets Medicine community, make sure to sign up for that by going to moneymeetsmedicine.com/update. It's one weekly email that gives you a personal finance educational lesson for the week, in addition to all the content and the discount deals and more. So moneymeetsmedicine.com/update to get all of that. So Justin, I mentioned last week that I saw this story within 24 hours of the one that we talked about last week. If you missed that episode, it was on physician real estate syndication deals and affinity fraud, and some really bad deals gone even worse than they could have. And a great episode. I think it's worth everyone to listen. So if you haven't listened, check this one out, then go and check that one out. This one is actually about a NASCAR driver. I grew up in a house that watched a little bit of NASCAR. I will admit publicly, I have not watched any since I left that household when I was a kid. And so Kyle Busch is in the news because he's suing Pacific Life. We'll talk about the details and why that's happening. But I have really no concept of who Kyle Busch is as a NASCAR driver. So I turned to Wikipedia, and Wikipedia basically said this guy's really good. Got the 9th most wins all time for NASCAR. And according to Wikipedia, he is widely regarded as one of the greatest drivers of his generation and in NASCAR history, known for his dominance across 3 of the NASCAR series. So this guy is apparently really good at what he does, which also means, as you can surmise, very wealthy. And so I think that plays into what's happening here in a lot of different ways. But basically, Kyle Busch and his wife, Samantha, lodged a complaint in Lincoln County, North Carolina, which some of you may not know. A lot of NASCAR drivers are from North Carolina. I, in fact, have one in my hometown. I was at a Halloween party with a NASCAR driver on Halloween. So just something that's around my neck of the woods. They, in this situation, paid more than $10.4 million in premiums for an IUL policy, so an Index Universal Life policy, issued by Pacific Life. They mentioned the agent. I'm not going to call him out on the show. I don't think it's really necessary at this point. But they basically claim that their out-of-pocket losses exceeded $8.5 million due to how the policies were designed, how they were sold, how they were administered. And so because of that, they are now going after Pacific Life because they believe that Pacific Life and Smith, the agent, I guess I will say his name, used misleading projections, unrealistic assumptions, basically material omissions in marketing these IULs to them, presenting them as kind of the safe retirement type vehicle. We talked about last week, quote unquote, when people use the words like low risk, when per the complaint, they involve substantial hidden risks to the tune of losing $8.5 million. They basically say Pacific Life didn't do their job, watching over their agent, that the agent did the wrong thing. And so what I find fascinating about this, right, is that in looking into this more, according to them and according to others, and according to somebody on Twitter who makes a living litigating this stuff, this happens a lot. And in their video that they released, they say it happens to normal everyday folks, like teachers. And I got a soft spot for that because my wife is a public school educator. She teaches 5th grade. And firemen and firewomen and police officers. And so, but when it happens to those people, they don't really have the means probably to come back and say, hey, didn't appreciate that. Let's go settle this in court. Whereas when they did it to this guy, who is the 9th most winning NASCAR driver ever, he probably has the means and the ability to fight back. And so it's kind of one of those situations where, I don't know, part of me like feels all warm and fuzzy about this. Like, yes, you finally picked on the wrong guy, and that wrong guy is going to take you to task because he has the ability to do that. And part of the reason why he's doing it is to stick up for the little guy and the little gal that can't stick up for it because they don't have the means to fight this giant insurance company. And so I found this riveting personally, but I don't know. I'll stop there maybe.
Yeah. So all this is public record, and we can probably post this in the show notes. This is unfolding just last month. This is November where we're recording. This is in October of 2025 when a lot of this is playing out in the North Carolina courts. And it's funny, as a financial advisor, I'm reading this sort of allegations and things and seeing this, it's the trust, and it's a lot of the building blocks are similar to strategies that I have seen in the past and frankly, like used to good effect in many cases. But here's the problem with complexity is things can either blow up in ways you don't understand, or, this is always true when you're working with an expert. You're trusting someone for the parts of the strategy that you don't have the technical expertise to be able to process yourself. You're putting the goodwill of yourself and your family in their hands. And it's unfortunate that in this case, and we're talking about an IUL, this is an Index Universal Life Insurance Policy, where premium payments are into the 7 figures. So you pay maybe like however many, $130 a month for your 20-year term.
Something like that, yeah.
We're talking millions of dollars a year that this family has sunk into this policy. And that's the back of the envelope math. I actually don't know how it works if you sold an $8 million IUL. I bet it's a pretty nice payday. But for the normies, maybe it's like 1 times first year premium. If there's an aggressive funding strategy, it could even be more than that.
So Kyle Busch mentions in one of the articles I was reading about this as I was going down the rabbit hole, a couple of things. He was promised basically that if he stuffed all this $10 million into this policy, that when he turned 52 or 55, I can't remember the exact age, that the policy would then pump out $800,000 a year for them, which is why they were viewing it as a retirement option. And the second thing he mentioned is that he found out that the agent's commission is 35%, which is interesting because that's lower than other insurance premiums and situations. Whole life almost always pays 50. I know disability insurance, pays 50-ish. So I was a little surprised by that. But let's say his 35% number, which sounds really conservative, but that dude made $3.5 million on a $10 million premium, right? That's a lot of money. You have to fool one person and then you can retire on 120 grand, 150 grand for the rest of your life. And so this is amazing. It's incredible, but you got to something I think is really important, which is complexity. And the reason why this matters for physicians is you may get pitched an IUL policy. The flavor that I see most often put in front of physicians is more like the Northwestern plain vanilla whole life insurance policy that they have to think through. But even that product is complex enough where when we start talking about infinite lending and like the tax benefits of it, people can talk circles around physicians who literally know nothing about money because that's not what their expertise is in. And so the complexity makes their eyes glaze over, and what they end up relying on, which is what you mentioned, is trust. And so it's important to do your due diligence on the investment opportunity or insurance product that someone's put in front of you. It's equally important to do your due diligence on the person that's recommending it. I think it's important to do both. But in my experience, and I don't know, maybe you can tell me you've had a different experience, Justin, but I almost know it's illegal to talk about life insurance policies as investment products. You're not supposed to pitch them to clients as, hey, this is an investment vehicle. That's not what it's supposed to be for. It is a life insurance policy that has a death benefit and has cash value associated with it. And then that's where you're supposed to kind of leave it. But people talk about things like returns, whether they're guaranteed or not. They talk about, hey, this is what you could do in retirement. And so even if they don't use the word investment, the way that they talk about them makes them sound like investments. And so people start thinking about them in that way. And then they just buy it hook, line, and sinker. It happens all of the time.
It does. And it's certainly, I don't know the technicalities because I actually don't market these types of products. I have reviewed a lot of them, and people often come to me. I've had a few cases in particular where they're working with somebody for a while and they feel this ratcheting up of commitment because it starts with something basic. And what I have observed is that the IUL is kind of like the crown jewel / the straw that broke the camel's back. And Perhaps if you find yourself working with an advisor who's selling you a thing and then selling you another thing, and I'll put advisor in air quotes here for our purposes, and then another like slightly more complicated, more expensive thing, if you're getting that like gnawing feeling inside that this feels like the pain is ratcheting up and I'm understanding this less and less and it's costing me more and more, that should tell you everything you need to know, or at least that should be a good red flag where you can get a second set of eyes or email Jimmy and ask him what you should do, because the IUL often is like part of that journey. And I've had a couple of people come to me and say like, I bought this IUL, I immediately regretted it. Now there's nothing I can do. Like, what are the options? It's not a problem with the thing itself. It's inert. It's a document. It's a 117-page contract. It's kind of complicated, but there are good and bad ones and proper and improper applications. But because of the complexity and because of the multifactorial benefits as they are described to investors, I do see these frequently as offenders where they're used improperly. They're sold to people that don't understand them. This is an extreme example of like, it's apparently a total loss. Hopefully that isn't happening to anybody out there. But if you are getting involved in these products because of the complexity, and I've reviewed a number of them and I'm not an IUL expert. I work with IUL experts and there are people out there that really do understand these things. And then there are people that sell them. And sometimes those are the same person. But I can tell you that if I was selling a thing that was a 117-page contract that had all these contingencies and flexibilities and a bunch of different expenses, and there's a lot going on, you better really know what you're doing if you're going to make representations to someone who's going to be buying that thing from you. And most of like the path of least training to be able to sell one of those things, it is probably weeks, not even months, to be able to be licensed to sell IULs. So you should know that. And this is where I'll harken back to that John Oliver episode about being a financial advisor. And I don't agree with a lot of things that he said, but this is one area where the path of least training to do that thing, like you should be aware of what that is. And it's just so happens that financial advisor is an unregulated term. Now, you do need some basic licensure to be able to sell insurance products, but it like you get a textbook and you cram through it and you can do it without needing to understand all the implications of everything in the 117-page document.
Yeah, I completely agree. Listeners know that I've registered for the Series 65 twice and then stopped taking it because I didn't want FINRA or the SEC in my world. I just didn't want the added complexity of that. But speaking of complexity, I think complexity is one of the red flags that should raise your antenna to say, maybe I need to talk to more than one person about this. Because I will say, in the 8 or 10 years I've been doing this, I have definitely come across certain physicians who purchased whole life insurance. They were super savers. They saved all of this money. And they're like, I just want one other place to save money. This is a product. And when they explained it to me, they really legitimately understood it. Like they really got it. And they're like, I understand I could put more money in the market or whatever, but there's some unique things about this. And they laid it out there and I recognize the risk that's involved. But at the end of the day, I'm saving so much money. I'm just looking for that one extra space. And honestly, in that situation, that's not the most unreasonable thing in the world.
I totally agree. That's a perfect profile of somebody who can definitely, and like harken back to last episode, like closed-end REITs, LPs, things that are more esoteric and illiquid. Sure. Like you're maxing out everything pre-tax. You're doing 6 figures a month or a year into a taxable account. Like you're just looking for a new mattress to stuff money into. Great. And insurance products can definitely provide a different risk return profile. And that can be a great tool. But it takes a while to get to that point. And most people that I see that have these things are not there yet.
No, most people still have $400,000 in student loans and they're not maxing out their 401k or their 403b. That's why you hear people in this space get so upset about whole life insurance, because the people that they're sold to and when they're sold to them is so wildly inappropriate and happens so often that from a big picture educational standpoint, it is unwise to basically not say whole life is terrible. Just because if you send out that blanket statement, you're going to get it right 99% of the time for the people that buy this product.
Yeah.
And so that's why people from an educational standpoint, which is where I'm always speaking from, are going to say whole life insurance is not right for 99.9% of doctors. And that's because 99% of you listening, it is not right for you where you are in your stage, to be honest with you. And I think one thing, I actually found this really interesting too. And apologies, by the way, for my video freezing for those of you watching on the YouTube channel. I'm not sure why that's going on, but if that happens, apologies. So another thing is I found this interesting. I was curious. So I was like, ChatGPT, which has become my friend. I'm like, hey, ChatGPT, is there any data from like the CFPB or other bodies that have done research on the rate of, let's just say, misconduct by financial advisors? And I found this report, The Market for Financial Advisor Misconduct, from 2005 to 2015, say basically 1 in 13 financial advisors had misconduct related disclosure of some kind. So that means a customer complaint, regulatory actions, up potentially to civil criminal events. And there was another one, public citizen, for the periods of 21 to 23, that was about doctors. Because I was like, hey, I'm going to be fair. I'm not just going to look at the financial advisors. So like, what is the rate for physicians? And for serious disciplinary actions, it was 1 in 1,000. For any disciplinary actions cited by the medical board, it was more like 3 to maybe 4. And I found that an interesting statistic, given what you said earlier about as complexity rises, so does your need to trust the individual that you're working with. And if 10% of advisors have some form of misconduct in their past, and there are studies by the CFPB, so basically Consumer Finance Protection Bureau, their job's to protect consumers, that have shown that people that are offenders are more likely to offend again. And they've also shown that certain companies, and I think the physician world would actually support this, that have higher rates of misconduct than others. I don't even have to name any. People can think of it off the top of their head. Like I can think of a name there, right, in this space where you hear it all the time, right? And so up to the tune of like 20% of their advisors instead of 10. So I found that really interesting in looking into that because I hadn't really ever gone into that data before. So is that completely false data, Justin? Is that false news?
The universe of professionals is sort of difficult to describe. There are different types of advisors, different types of insurance companies. So I'd be curious to understand like what data set ChatGPT is working with. I would observe that there are readily available and accessible. And I was actually, before the show, I was just Googling because I'm a little more old school than you, Jimmy. I went to google.com to type in this query. And I was looking at regulatory judgments against this, one of the parties involved in the sale of this financial instrument to Mr. Busch. And it turns out that one of the guys had a felony drug conviction in 2018 and should not apparently have been able to sell insurance anywhere. And I'm looking at like letterhead from the state of North Carolina Department of Insurance. This is the kind of thing I found in 120 seconds. And this is no knock on the victim of this financial crime. But if I was committing millions of dollars to a strategy, I would probably be paying people to do this kind of work. To say like, I want background checks on all these people and we need an exhaustive regulatory and like summary of disclosures to make sure that we know who we're working with. I also observed, and this is a good sort of check for anybody who's emailing their professional, there was a lot of correspondence showing in the court paperwork here that was to a personal Gmail account, meaning the investor, in this case, the Busch family, or they're emailing their advisor in air quotes, and it's to a personal Gmail account. And the type of cataloging and classifying of that kind of correspondence, there are very high bars set for the capturing of all communication to any client in the financial industry. And I guarantee you, this was probably an off the reservation type of communication. I doubt it was nefarious, but it's certainly careless. And it's showing a lack of compliance awareness or compliance adherence. This is the technical thing that I noticed because everything that I do is from my domain. But if you're an investor out there and you're communicating with your advisor across different means and you find a personal email address is an important part of your correspondence history, that should make you raise an eyebrow.
Yeah, I found that interesting. I actually didn't know that when you mentioned it to me. And we also talked about a tool. So there is the FINRA broker check where you can look up individuals and see if there's been misconduct on their record, although it's interesting that we found all this stuff outside of the FINRA broker check on this person. And so it kind of go back to the point that I mentioned earlier, where you need to do your due diligence on the product and really understand it, like really, truly try to understand these things before you put hundreds of thousands of dollars or millions of dollars into them. And also equally important to do your due diligence on the person selling it to you. And the due diligence can't be, well, my dad uses them, this financial planner for the family, or like, hey, this is the person that my best friend, or hey, it's my brother. Like I'm sorry. Like I can't tell you how often that happens. Like, Jimmy, I've been listening to Money Meets Medicine for a while, and I kind of started to realize like I'm getting bad advice and I'm worried about it. But the problem is like this person's been my financial planner because it's my parents' financial planner, or it's my uncle, or what have you. And so I don't know what to do. I don't know how to get out of this financial relationship with this advisor that I know personally, or that has been in my life for decades. And so I just point that out to mention that like, just because you know them, it kind of goes back to the concept we mentioned in the last podcast of affinity fraud, where you get to know and trust somebody enough that you think that they must be good at their job, or someone that you know because your chair recommended them, or your best friend uses them, or what have you. It's really scary. It happens all the time.
I totally agree. I'm working with someone who comes from another advisor. there's two main drivers. And one is like this product orientation that a client is becoming increasingly uncomfortable with. And another is this discomfort with having two kinds of relationship with one person at one time, which is something I talk about. It's like a hazard of personal finance. Like if you're both someone's sibling and their landlord, that creates hazard. If you're someone's spouse and their business partner, that creates hazard. Like, which am I in this moment when we're having a conversation about you're late on rent? And so this is an area where, I mean, I like keeping business and personal separate. And it is one of those areas where if there's not that threshold of due diligence being applied, like if your brother's like, yo, let me manage your investments, you're not going to be like, let me double check your broker check history and make sure you don't have any disclosures that I should know about. I mean, maybe you would do that. And to your credit, that's awesome if you are that person. But you actually should do that. But people don't, obviously, because people are people and that's not human nature. But you're at risk if you find yourself in that position.
Yeah. And so this story is still unfolding. There's going to be a broadcast of some kind about this situation. And so by the time you listen to this, since we record in advance, maybe that broadcast started to come out, maybe it hasn't. But something to keep your ears to the ground about, as I find it a really interesting situation and a great example for some of the reasons that we discussed on this episode. This is not unique to NASCAR drivers. This happens on smaller scales all the time in the physician world, in my experience. And so I'm just throwing it out there as a cautionary tale so that you can be aware of some of the red flags to notice. And Justin, I always appreciate your perspective, being from the financial world and doing financial work day in and day out, and the take on your perspective. Don't forget, as we head out, there's a new update that you can get that has the weekly content, the blog, the podcast, the YouTube video, additional lesson of the week from an educational standpoint for personal finance and career advice for physicians, in addition to discounts and deals. It's sent to your mailbox once a week on Wednesdays. You can get access to that by going to moneymeetsmedicine.com/update. Toss your email in there and you'll be on the email list and get that each week. Make sure you don't miss anything. As always, we'll see you next week. Cheers.
Justin Harvey is a certified financial planner at APM Wealth, where he helps anesthesiologists and pain medicine physicians. Dr. Jimmy Turner is a practicing academic anesthesiologist at Wake Forest in North Carolina. He's also a licensed insurance agent. However, either Justin or Jimmy are your financial planner, investment advisor, or insurance agent. This show is expressly for general education and entertainment purposes only. Nothing should be considered financial advice. All views expressed are solely the views of the guests on the show and do not represent the views or opinions of their employer.